Good morning. This is Dylan Jovine with Behind the Markets. Happy Friday. Today is Friday, April 25th, and it is Bring Your Child to Work Day. Now, my daughter has gotten too cool. Actually, she's studying for big exams, but my son, Teddy, is here, and I get to bring him to work, and we do this every single year. So, we're going to start working. I'm going to show him a little bit about what I do, and he gets to meet the people that I work with and all that kind of fun stuff. And of course, there are donuts here that he gets to eat that I'm really trying hard to avoid. Anyway, today I want to talk about the volatility, where it stands on a historic basis. I was talking to a friend of mine last night who was like, look, I look at my 401k and it's giving me panic attacks. And I was like, I understand. Some days it's really up. Other days it's really down. He's like, what do you make of all this volatility? And this April's intraday volatility, basically the average difference between highs and lows in the same day trading session, is on pace to be the highest since COVID. And it's the fourth highest. I didn't know this. I dug into some research. It's the fourth highest volatility range since 1979. And it only is beaten by two things. Basically, the 2008 financial crisis, 2 months in 2008, and of course, October 1987. So look, more volatility is a general rule. Volatility means prices can go up or down, but history tells you it's pretty much a bad thing. There's an old expression on Wall Street, and that's markets take stairs up and they take the elevator down. That's the old expression they used to say on Wall Street. Volatility usually comes with a lot of uncertainty. And you have this kind of split screen scenario. Before we went into this period here, we all knew the market was high. It was trading at historically high PE rates. But the underlying economy was doing fine, of course, driven by fiscal spending. But now you have a situation where companies are reporting their quarterly earnings, and a lot of them are good. Again, this tariff policy didn't start basically in the first quarter, so they wouldn't even show up in earnings until next quarter. So a lot of the actual earnings for the first quarter of the year are good, but on these conference calls, these CEOs are saying, look, our input costs are going up. There's tariff uncertainty. But companies have one of two ways to play that when you're forced to pay a tariff this big. One is you pass that cost directly to consumers. Two is you absorb the cost and try to take market share from your competitors who can't afford to do that, which is what Walmart's going to try to do. But your profits go down anyway. So no matter what, if you pass it right to your customers, less people will be able to buy. They'll be able to buy less of your products. And if you decide, like a Walmart wants to do, be very predatory, smart in business, use this as an opportunity to gain market share on Target or whatever, you say, you know what, I'm going to absorb as much of those tariffs as I can. I know my profits are going to go down, but over the long term, I'm going to take market share, which is what we're playing for, which is what Walmart is playing for. And they have the balance sheet to do that. But a lot of early recession indicators are showing airline booking travel always drops. People have less discretionary income. So airlines are reporting very weak travel demand, always a recession sign. Credit card companies, they're starting to push away, sock away reserves. So you have a Wall Street that is at war with itself. It's fighting with itself. Is it a bull? One day it's a bull, or for a couple hours it's a bear. It's a bull, it's a bear. It's a big argument among bulls and bears on Wall Street. And it's I've always found it interesting how that fight is expressed into the stock market, through the stock market, really. Another word, I just wanted to touch on China for a moment, these China tariffs. It's an interesting situation. The Trump administration this week seems to be walking back their desire for tariffs. So we'll see what happens. We will see what happens. Interestingly, Scott Bessent, our Treasury Secretary, said at a private JP Morgan conference, he said basically what we've done to China is a trade embargo. And I thought his use of the word embargo was very telling. Embargoes are a very serious thing, and they're really acts of war. Make no mistake about it. You think of the UK, Britain, basically embargoing Germany in World War I and in World War II. You think of the United States, people think Pearl Harbor just happened out of the blue. The evil Japanese Empire just decided to attack us on Pearl Harbor, December 7th, 1941. That's not really what happened. Basically, 128 days before Japan attacked us at Pearl Harbor, We embargoed, we put an oil embargo on their oil and we froze their assets. Japan's reaction to that was to attack us at Pearl Harbor. A lot of folks, when you're looking at what's happening with China here, this trade war, this embargo, China, if you're in China's shoes, you think to yourself, that's an act of war, perhaps, certainly financial war, there's no doubt about it. Basically, the fact that our side is hearing or looking at it through the prism of trade embargo, then President Trump, of course, downplayed it and started to walk back that. He said, I'm going to be very nice to China. So it seems this week that they're really trying to put out an olive branch, but China is really sitting there saying, look, whoa, we're going to do what we think is in our best interest, which is a very vague and interesting comment. So anybody who tells you they know where the market is going is full of it, is full of BS. Nobody knows where the market's going because it's being driven to a larger degree than historically large degree. It's being driven by external events, politics, and now the possibility of maybe conflict with China. Anyway, that's all that I have. Have a wonderful day. I will see you on Monday.